So I stumbled across this in a news article somewhere, and basically Hargreaves Lansdown are possibly one of the largest financial institutions that deals with investments, stocks, shares, all that sort of thing. So the government has announced plans to sell at least 2 billion of Lloyds Banking Group shares to the general public. Now, the 2 billion shares that the government owns were obviously bought during the banking crisis in 2007, 2008, that sort of era, when obviously the bank's stock price was massively reduced. And Lloyds Bank, being one of the main banks here in the UK, it's affiliated with, it used to be affiliated with Lloyds TSB, which was multiple banks joining together. They've now split up, so it's gone back to the standard Lloyds Bank. The Lloyds share offer was expected to take place in spring 2016, although George Osborne has now said he will wait until turbulent markets have calmed down. As the UK's number one stockbroker, Hargreaves Lansdown welcomes the news that the general public will be able to participate. What we know so far about the terms of any offer. Final details will be confirmed when the Lloyds share offer opens. Applicants of up to £1,000 would be prioritised. Investors will receive one bonus share for every 10 held for a year, subject to a cap. Shares will be offered at a discount of 5% to the market price. The value of shares can fall and rise, so you could get back less than you invest. So yesterday, when I actually found this story, it was about 70 pence per share, and it's dropped again today. So what I want to show you now is just how well this company has grown since the time the government purchased the shares. But I'd also like to remind you guys that with one of my other posts regarding the job cuts that Lloyds is currently facing, and this is from the 2014 period, across multiple banking groups, 9,000 jobs are to be lost across the banking industry as they're outsourcing those roles to India. So that's confirming that things are still not that great here, and they're really having to cut costs to increase profits. So this is published by The Motley Fool. It's like a finance and investing website. On the 9th of December 2015, I boldly proclaimed that Lloyds Banking Group is my top stock pick for 2016. With harrowing inevitability, the share price started dropping almost immediately. At the time I tipped it, Lloyds traded at around 72p, which actually is roughly the price it is today. Exactly 2 months later, it hit a low of 56p, having fallen more than 20% in the same time. Some tipster I turned out to be. Laugh out Lloyds. Happily, for my sense of self-worth, Lloyds has recovered from its shocking start to 2016. Today it trades at 67p, so it's now down only 7% since I tipped it. But that's still a long way from the sunlit uplands I was envisaging. So what went wrong? In December, markets were still anticipating a Lloyds retail investor flotation. It was supposed to be fully in private hands by June, but January's market meltdown put a stop to that. Banks were at the epicenter of global storms, with British banking stocks suffering from the sins of their European cousins. So you're telling me that the British banks had nothing to do with the storms. So in part, Lloyds is an unlucky victim of wider circumstances. Yeah, sure, they're unlucky. Yet it has actually fared much better than rival Barclays, for example, which is down 23% since the 9th of December, while Royal Bank of Scotland is down 15%. Lloyds still looks like one of the safer prospects in the troubled sector, so a minimum of a 7% loss is safe. Lloyds leaps. Investors saw Lloyds in more positive light when its 2015 results were published, showing an underlying profit of 8.1 billion, up 10%, and a healthy 15% underlying return on equity. The share price leapt almost 10% on the day, helped by signs that legacy issues such as the multi-billion pound PPI hangover were now clearing. The results were another stage and post on the comeback trail. One reason I hailed Lloyds was for the relatively conservative nature of its revamped business. And although that didn't protect investors from January's global meltdown, its Tier 1 capital ratio of 13.9% still has the beating of most banks across Europe. Income machine. Lloyds won't be immune from further stock market storms, and as I rightly stated in December, it won't be a bumper growth stock. I also warned that earnings per share were forecast to fall 8% this year. The reason I singled it out for praise was for its glorious dividend prospects. Concluding that, with dividend payouts crashing all around it, Lloyds set to be the income hero of 2016. My confidence was repaid when management announced an additional special dividend of 0.5 pence per share at the end of February. This suggested to me that management is willing to reward the faithful through thick and thin. Income seekers will be expecting more thick than thin, with markets forecasting that the stock will yield 6.5% by the end of the year, rising to an even juicier 7.6% by December 2017. But unexpectedly, in market shock, on the 9th of December, you could buy Lloyds at 8.6 times earnings. Today is valued at 8 times. That makes it an even better buy than it was then. I'm not alone in thinking. On Monday, HSBC added the bank to its Europe Super 10, rating it a buy with a target price of 80p, rather than being my worst ever share tip. Lloyds could still prove one of the best, just give it time. I reckon that Lloyds is one of the best income stocks in the UK market today, but there are other exciting opportunities. And here's a post from October 2015 on the Guardian UK website. Lloyds bank share sale. 250,000 people register on the government website. The figure dwarfs level of interest in the Royal Mail sale as Treasury reduces size of stake in the bank to 11%. So in 2008 and 2009, the stake stood at 43%. Around 250,000 people have registered to buy shares in Lloyds Banking Group. The government said as it sold down a further stake in the bailed out bank and removed some of the complexity of its holding in the Royal Bank of Scotland. Even as it prepares an offering of Lloyds shares to the public, the government is continuing to sell off shares to big city investors. The stake now stands at just below 11% as George Osborne continues with a plan to dribble out shares onto the stock market. At the time of the bailout in 2008 and 2009, the stake stood at 43%. In a separate announcement, RBS said it had permissions to tidy up its shareholder structure by converting the B shares it issued to the government in 2009 into ordinary shares. The B shares were issued at the height of the banking crisis to pay for asset protection scheme, which was required to insure its most troublesome loans, and were a mechanism to prevent the government's stake in RBS rising even further. The Chancellor said the sale of the Lloyds stake had raised 15.5 billion for the taxpayer, and 250,000 people had signed up on the government's official website to register an interest in the sale. About 2 billion of the shares in Lloyds will be priced at a 5% discount to the market price, and any investor who holds them for 12 months will be given a bonus share for every 10 they hold. This sale is not expected until next spring. I am determined to build on this success by making Lloyds shares available to the public next spring, so that we can build a share-owning democracy and continue to reduce our national debt, said George Osborne. While comparisons of previous sell-offs to the public remain tricky, around 45,000 investors expressed an interest in the Royal Mail sell-offs during its registration period, which lasted for 16 days. Investment firm Hargreaves Lansdown said on Thursday that so far 120,000 people had signed up with the company for the sale. The government has only just started selling off its stake in RBS, cutting it from 79% to around 73%. By selling shares to hedge funds and institutional investors, at the end of the month, the next opportunity arises for Osborne to sell off another chunk of shares, as the bank will report its third quarter results and the 90-day period preventing a further sale will have expired. RBS shares were trading at 334p around 10 a.m. in London, below the 502p at which the government breaks even on its stake. Lloyds' share were trading at 77p, above the 73.6p break-even point. Okay guys, so the Lloyds banking shares were purchased for 73.6p and the RBS shares were purchased for 502p. Now, it doesn't matter really if they break even or don't, because we all know that QE is just going to increase the value of these shares. But how this all links together into why they're not selling the shares off just yet is because they're probably trying to prop the banking up at least to the break-even point. So you could imagine that when these increase by another 4p, that may be the time that he's looking to offload the remaining £2 billion worth of shares. So here's a picture of the Lloyds Banking Group shares from 1990 to today. So you can see how much they've gone down from their peak in 2000 of 500 down to today's level, floating around the 60 to 80 range. So the bank, so the government came in 2008 and purchased at about this level here. I think it was, what did we purchase for? Around 72 pence. And it's been pretty flat across this line. Now, when I zoom into the 3-level period, you can start to see that it stays within a very tight margin. 74 pence, goes up to 80, comes back down, highest point 88. And then, as we all know, at the beginning of this year, things did not go that well at all for banking, and yeah, it crashes right back down. Now, we all know how quantitative easing and the governments are pumping huge amounts of money into the stock markets to try and keep certain companies' appearance of profits, and now's the time to invest. So I think what you will see shortly are Lloyds Banking Group shares increasing in value to the 75 mark, at which point I think you'll probably see the release of these 2 billion shares to the public. And what is extremely concerning is they are increasing the incentive with a 5% reduction off market value, which will encourage a lot of investors to dump a huge amount of money in. And the first people that invest will probably make a little bit of money if you're going for a quick flip. However, it's going to be the people that are holding it long term for the incentive, which is this part here. Investors will receive a bonus 1 share for every 10 that they hold. So people that are going for a long hold for the year to increase their holdings by effectively 10% could be spelling a huge explosion in the market, because I don't think anybody is going to make money out of this deal other than people in the short term going for the quick flip when it becomes highly publicised that Lloyds will be doing this last final sellout, privatising the bank and putting the spin that everything is great, full well knowing that this whole banking crisis is about to explode. So they're wanting to clear this 2 billion of shares off of its balance sheets before effectively they're worth nothing. So my advice to people would be to do your own research and be extremely careful if you're buying into any form of banking stocks, because turbulent markets is going to be this year's undoing. The Deutsche Bank, the European nations are all having extreme turbulent markets. The American markets are turbulent. The Asian markets are turbulent. They're trying to make out we're going to give you this great deal, but this is just another way for them to spin a story in order to eliminate people who have wealth, to eliminate the middle class due to their own personal greed of free shares and discounted rates. Do not buy into these false claims of dividend yields. So really, you shouldn't be falling for the stocks and shares, not in a time like this. This is the sort of investment you should have made. He seemed pretty content with only having a 7% loss. While if you invest in real money, this is the real gain that you could have seen, which is actually a positive % increase in the value of your investment. And the markets have not even started to gain yet. As soon as these banking institutions start cracking at the seams, which they already are doing, you will see this price astronomically jump. From an example, we can go back to the peak times during the recession, and it is a lot higher than in today's market. Alternatively, we can see the price in silver. Again, if you were buying around the time that these shares were up for sale, your shares will have made a loss. However, the gains that you will have made through the precious metals are steadily climbing. And you have to ask yourself, why are these markets climbing? It's because they know there is serious issues in the banking industries and the stock market. People are flooding out. Now these markets, they're manipulated, and they're still manipulated to today, but they're not going to be manipulated for much longer. And with all this manipulation, they're still able to grow. And that shows you the sheer volume that is starting to get into this industry, starting to understand what real money is. And it is the only safe place that you can park it. And if you think this looks like reasonable gains, all you need to do is look at what they did in 2011 during the 2007 crash and see how they responded. The levels that we're at here today, this is where we're going to get past during this recession. So if you invest your money not in the stock market and in these banking shares, but you put it into what has been money for the last 5,000 years, you'll be able to sleep easy at night because you know you have made the right decision. You know you have invested in real money, and you will see fantastic gains superseding the highs of 2011, because 2011 was artificially corrected by the banking term quantitative easing. They no longer have that ability to suppress this market. The Chinese are now correcting the COMEX lies. The Chinese have implemented a fair trade system where you cannot trade the physical metal with an artificial paper price. There will be two benchmark prices in this world. There will be paper market, which is the ETFs, and the iShares, which is on the COMEX, and you will have the Shanghai Gold Fix. And when the main miners are selling all of their inventory to China because they're getting higher fare, it will only be a matter of time before nobody invests in the COMEX. I hope you found this informative. So thanks for watching. Now, I just wanted to show you what the situation is with this account and although I'm bringing in views, not many, but a few, it's really important for me as a channel for you guys to help me out by leaving some comments and giving it a thumbs up and really subscribing to this channel, because without you guys I'm not actually going to be able to continue with this content, simply because if I'm only generating minimal amount of views, it's not really worth the time that all this content takes to create and upload. So if you really want to see what's happening from the UK and hear what I've got to say about things, then I really do need your support. So please do subscribe, please do leave comments, and please do leave a thumbs up, because all this helps the promotion of this channel, and that then means it ranks higher up in the analytics of the YouTube search engines when people are looking for things. I'm really trying my best to put the message across to the UK people, but without getting awareness to this channel, it's not going to get any light of day. You can see the views that I'm generating, but I'm not getting any thumbs up, and I've only generated 25 subs. Now, the biggest impact I had on my video was this one here, when it was posted on the SGT report, and the numbers are fantastic. However, because this was probably my first video and I was a little bit nervous with speaking for the first time, for some reason people weren't really interested in sticking around, so the numbers seriously dropped off for the part 2s and 3s. And this is when the information actually started getting quite interesting, especially in the part 3 when I sum it up at the end. But, you know, only 10% of people made it through that far. So with your help, guys, let's make this a better channel from the UK. And maybe this is the reason there aren't many channels from the UK. Take care.